Hello everybody, welcome to this week's edition of Northwest Quadrant Wealth Management E-News. Thank you for joining us on the last day of May. So today we're going to probably sound like a broken record again, but there's not a lot of new and interesting things to sort of talk about other than what the stock market and bond market is focused on, and that is the interest rate environment. So, most of my life and most of your lives out there watching this, fundamentals have mattered. Interest rates always matter as it relates to risk assets, but the market is solely trading on what they are anticipating interest rates to do. And so that's why when we get the inflation data like we got today, we got the Personal Consumption Expenditures Index, the PCE for short, which is the Federal Reserve's favorite gauge for inflation. It came in the month of April up 0.2%. Over the last year, 2.8%, which was in line with expectations. But it's been there, it's been stubbornly sort of stuck there for quite some time, and the Fed isn't making much headway in continuing to move inflation lower to their 2% target rate. So the market is sort of unsure how to interpret that. Are they going to leave rates higher for longer? Are we going to get a cut in September? And so really it's funny, when you look at the market and you look at all the things that should matter, all that matters at the end of the day for market participants right now is what is going to happen with interest rates. The risk on trade still sort of persists because most market participants think we're going to get a couple of rate cuts in 2024. I'm not necessarily in that camp. I look at the U.S. economy and I don't see that the interest rate environment we're experiencing today is restrictive. I see lots of economic activity in the history of my life. I see the amount of activity in the U.S. economy as being pretty robust, and I don't feel like the Federal Reserve needs to cut interest rates to make it more robust, because to me that means more inflation. So only time will tell, of course, but really when we look at 2024, it's sort of playing out like we thought it was going to. We're optimistic about the year, but we would be experiencing bouts of volatility, and we certainly saw that in the month of April. But at the end of the day, over a long period of time, all that matters is earnings, and Josh can tackle what the earnings picture looked like last quarter.
The Fed obviously has a pronounced bias toward cutting. They have since December, and when that downwardly revised GDP data, the economy is certainly slowing. You're starting to see a little bit of weakness in the jobs market, not really pronounced. And of course, there's going to be more than 4 million baby boomers retiring this year, and somebody's ultimately got to replace them. But then when you look at the earnings side, earnings growth over 10%. So awesome earnings growth. Guidance wasn't so bad. In the small and mid cap space, earnings growth actually outpaced the S&P 500. Those stocks still remain really cheap compared to the overall broader market. But for the first time in 3 years, stock price appreciation is actually coming from earnings growth rather than just people being willing to pay more for the same dollar of earnings. And that's something that we should all want to see. Valuations are, of course, still pretty expensive relative to historic levels, but there's just that tidal wave of liquidity, and of course all that money has to flow somewhere. And so when you look forward, we're still pretty optimistic for 2024, and with the Fed's pronounced bias towards cutting going into next year, that's I think when you'll finally start to see some action in the small cap space that's really outperformed as of late, but lagged pretty precipitously over the last 10 years or so.
But the fact that earnings grew more than expected and earnings grew as much as they did last quarter means that stocks actually got a little bit cheaper, which is the first time, like Josh said,
even though the market's gone up
in quite some time. So the other sort of positive that nobody really talks about, but it matters for a lot of you, is that for the last 15 years we've seen no return on our safe money we had in the bank, CDs and in bonds. And the good news is we're finally seeing some real actual returns, whether it be in bonds, on the bond side of our portfolio, or some of the money that you have in the bank, which is sort of the silver lining for a lot of you that have been conservative investors but also have done the right thing. So we're finally seeing some real returns in the bond market. So as always, if you have questions about your account or your situation, give us a call at the office. The number here is 800-743-0988, or you can always send either one of us an email, Josh or Tyler at northwestquadrantwealth.com. We'll see you back here in a couple weeks.